All right, let's jump right in. Today, we're going to pull back the curtain on the real engine room of private equity, deal sourcing and due diligence. Look, this isn't just about ticking boxes on a checklist. This is the art and the science that separates a mediocre fund from a truly top-tier performer. It's all about how the very best in the business find incredible value where everyone else just sees noise. So let's get into it.
I want you to start with a number in your head. 800. Imagine you're a partner at a big, well-established buyout fund. Over just 1 year, your team looks at this many potential deals. 800 companies. 800 different paths you could take. That's a massive, massive ocean of possibility.
Okay, so you've got 800 opportunities on the table. Now look at this number, 5. Out of those 800 potential companies, this is how many deals that fund will actually do. Just 5. That's a conversion rate of, what, less than 1%? The simple truth is, almost everything a PE firm looks at, it says no to.
And that right there is the multi-million-dollar question, isn't it? How do you build a system, a process, a culture that is so sharp, so rigorous, that you can consistently sift through hundreds of potential landmines to find those 5 absolute gems? The answer to that is what defines success in this entire industry.
Well, the answer lies in a really powerful idea, the deal funnel. It's not magic. It's a super disciplined, 2-stage process that's designed to systematically shrink that huge number of possibilities down to just a handful of investments that you believe in, 100%. Let's break down what those 2 stages actually are.
First up, you've got deal sourcing. Now you can think of this as the very top of the funnel. It's the constant, active grind of casting a super wide net to generate a pipeline of potential deals. It's all about making sure you get the right 800 opportunities walking through your door in the first place.
And then, once a company actually makes it past that first filter, it goes into due diligence, or DD, as you'll hear everyone call it. This is the interrogation phase. It's where you spend the time, the money, the resources to stress test every single assumption you have. This is how you find and cut out those 795 losers.
So, let's zoom in on that first step, sourcing. I mean, where do these 800 potential deals even come from? Generally speaking, they flow in from 2 totally different channels, and each one has its own set of pros and cons.
And those 2 channels are proprietary and intermediated. Now, intermediated deals are the ones brought to you by investment banks. They often turn into a competitive auction, which, yeah, can drive the price up, but on the flip side, it tells you the seller is serious and organized. Proprietary deals, though, are different. These are the ones you source yourself directly through your firm's own network. They're built on relationships that can take years to build, and believe me, your investors, the LPs, absolutely love them, because it often means less competition and a much better price.
And you can really see this preference for proprietary deals when you look at the data. This survey from Teton shows it pretty clearly. For a typical fund, that proprietary network, your direct relationships, is the biggest single source of deals. We're talking around 40% of the entire deal flow. Sure, investment banks and M&A shops are super important, especially for the mega deals, but that self-generated flow, that's the bedrock. So that brings up a really good question for you to think about. Why do you think LPs, the investors in the PE funds, are so obsessed with firms that can generate their own deals? Well, it really boils down to one simple thing: avoiding a bidding war. A proprietary deal usually means you're the only one at the table, which can lead to a way better entry price and better terms. You're creating value before you've even signed the check.
Okay, so you've sourced a promising target. Awesome. Now we move to the next absolutely critical stage, due diligence. If sourcing is about finding the needle in the haystack, diligence is about making damn sure it's a needle and not a rusty pin you're about to step on. This is all about playing defense.
Yeah, this is really where the rubber meets the road. Before a single dollar of the fund's capital gets committed, that target company is put under a microscope. The firm brings in the cavalry, accounting firms to do a quality of earnings report, top law firms for the legal DD, maybe even strategy consultants to kick the tires on the market. Their job is to find any red flags buried deep beneath the surface.
In this whole process, it's not just some random fishing expedition. It's super structured around what we call the 4 pillars. First, commercial DD. Is this a good market to be in, and does the company have a real competitive advantage? Second, financial DD. Are the numbers legit? What's the real earning power of this business? Third, legal DD. Any hidden lawsuits, nasty contracts? And finally, human resources DD. Is this the management team you want to bet on?
So as you can imagine, that DD process is a ton of work and money. It really hammers home the point that whatever you let into your funnel has to be worth all that effort. And that brings us to a little pro tip here, something that really captures the mindset of the best deal finders, especially when they're not in the big obvious markets. This is about seeing what no one else sees.
And this is just a brilliant way to think about the difference. Nicholas Bloy of Novice Capital Partners uses this fantastic analogy. He says sourcing in mature markets like the US or Europe is like waiting for the bus. The deals are packaged up by bankers, and they kind of just arrive. But in emerging markets, he says it's like finding an angel in a block of marble. The opportunities are hidden, they're raw, and you have to have the vision to reveal them.
And this quote from Bloy just nails it. He says, self-generated deals start with the philosophy that opportunities are everywhere. They are waiting to be revealed. You hear that? It's not a passive thing, waiting for a banker to call you. It is an active, creative hunt for value, driven by the belief that amazing companies are all around you if you just know how to look.
So where does this hunt actually happen? Well, a lot of the time it's in the most normal, everyday places. It's you walking through a supermarket, seeing a local brand that's flying off the shelves and asking, wait, who actually makes that? It's talking to old classmates at a reunion, driving through some random industrial park, or doing research to figure out what new products people are going to start buying. It's all about being relentlessly curious.
We've covered a lot of ground here, right? We've gone on the whole journey, from that giant pool of 800 potential deals all the way down to the final 5. From casting the net to dissecting the catch. So let's boil this all down to the most important things you need to remember.
Okay, if you remember nothing else, remember these 3 things. First, sourcing is a funnel. Success in this business is a numbers game, but it's built on a ruthless system for filtering the many to find the exceptional few. Second, the best deals are often found, not given. That proactive proprietary sourcing, that's a huge differentiator. It lets the top funds create value where other people don't even see an opportunity. And third, diligence is your defense. It's the essential shield that protects your capital from bad deals.
So there you have it. You've got the framework, the playbook that the best PE funds in the world use to find and validate their investments. The process is clear. The only question left is the one every investor has to ask themselves. Where are you going to find your angel in the marble? Where will you find your alpha?